Okay, this is Manolo's journey. I'm going to get into the markets, just go over a broad overview, and then get into crypto. As early September 2025 comes around, there's no universally agreed upon signals if there's a great market crash beginning. There is a bit of a confluence of troubling economic indicators and increased market volatility, raising some red flags for investors and economists alike. The current financial landscape is a bit of a mixed bag of resilient consumer spending and a cooling labor market, which is propped up against a backdrop of persistent inflation and geopolitical uncertainty. Just for some context, inflation is up at 3.2%. In July, it was 2.7, and in June, it was 2.4. This is also tied into some unemployment numbers that recently came out. Unemployment is at 4.3, a slight increase from July, which was 4.2, and June was 4.1. This is apparently pressing the Fed to lower interest rates. Recent market performance has been choppy all around. Indices like the S&P 500, Dow Jones, Industrial Average, NASDAQ have experienced some downturns in recent weeks. The tech sector has been showing particular vulnerability. This follows a period where the market had reached near all-time highs, prompting concerns about possible overvaluation, which I think we're not just yet there. While a market correction of about 10% from the peaks was noted as having started in mid-March this year, it's not yet escalated into a full-blown crash. A closer look at underlying economic data reveals a complex and in some ways contradictory picture. U.S. economy saw a slowdown in GDP growth in the first half of 2025. Still, the second quarter registered positive growth, with consumer spending being resilient. This consumer strength is being tested by in the uptick in inflation that I just mentioned, which chips away at the purchasing power of the consumer. The labor market, traditionally, which being what's making the economy strong, showing signs of softening, while the overall unemployment rate remains pretty low, but it is going up. Job cuts, the trend coupled with a slowdown in hiring suggests possible weakening in the job market that could have ripple effects throughout the economy. The experts are saying that there may be a crash. Some are saying that it's too early for that. So there's a lot of division there. Some institutions do not consider a severe crash as their base case scenario, but they acknowledge the probability of a significant correction is happening. They're pointing to several risk factors, including stretched stock valuation, the uncertain path of the federal monetary policy, and ongoing impact of international tariffs on corporate earnings. Many are saying, that the tariffs on corporate earnings are really a tax on consumers because they just simply get passed down if these corporations cannot take a hit and continue to be profitable. Rising treasury yields are another area of concern as they can make safer government bonds more attractive to investors. So if bond interest rates that you could invest in, which is government debt, continues to go up, it could potentially take some money out of the stock market that's a little bit more risky than bonds, treasuries. Some more bearish analysts are sounding the alarm, drawing parallels to historic market crashes, highlighting classic warning signs of speculative bubbles in certain sectors like AI. Robert Kiyosaki has been calling for a market crash for years now. In contrast, other experts maintain a more optimistic outlook, citing underlying strength of the U.S. consumer and continued potential for innovation to drive economic growth. Morgan Stanley, for instance, has recently upgraded its outlook on U.S. stocks. Historically, major market crashes have been preceded by a combination of factors, including asset bubbles, excessive speculation, tightening credit conditions, and significant economic shocks. While some of these elements are present in current environment, the overall picture remains ambiguous. I say it's too early to get out of the crypto space. Hold on, and I don't think that we're in the top quite just yet for indices like the S&P 500, Nasdaq, but we may be coming to the top soon. So as we look forward, I say, rather than investing, continuing to invest in indices and cryptos, although right now there's been a dip in crypto that I personally would continue dollar cost averaging into. The safer bet is silver and gold. I think silver has more profit, more return on investment. AI, DeepSeek from China predicts a $5 to $7 XRP, which I agree with. Silver, the target is $70, which would put it at 50 ounces of silver per 1 ounce of gold at today's value of gold. So by that time, it could possibly be higher. So I'd say anywhere between $70 to $80 silver ounce price target is pretty much in the bag for all my precious metal heads out there. And, just to keep you guys abreast of what's going on with XRP, it's been ruled not a security. So the SEC has no jurisdiction over the rules as far as this particular digital asset. Stellar, very big news. The U.S. Department of Commerce has published economic data on chain of GDP figures and is using the Stellar network to publish those numbers. Ethereum at 42.59 currently has been in the middle of a shift to proof of stake, reducing energy consumption. Bitcoin currently at 110, 132. Seems like it's going to be going up. There's the next Bitcoin halving happening April 2028. The last was April 19, 2024. And that's all I got for you. As a side note, I would say look into Quant and IOTA. They have the least amount of supply in this crypto space. If you're interested in AI, HBAR has some very good partnerships and it's still priced under 25 cents at the moment. Algorand also has some good news going on. And yeah, hope you guys are having a great weekend. Peace.